this lesson, we'll be looking at another very powerful trend-following indicator, Bollinger Bands, designed to measure volatility and strength of trend. So some of the things we'll be covering in this lesson include the Bollinger Band indicator and what it is, understand how Bollinger Bands actually work, applying Bollinger Bands to our charts, how to use Bollinger Bands, and of course, how to use them with entry and exit signals. So the indicator was created by John Bollinger and designed to encapsulate price movement of a stock and measure the overall volatility and or trend direction. The indicator is based on a moving average that defines the medium-term trend based on the time frame you are viewing. It is useful to determine overbought, oversold levels in the share price and may also be used to monitor it for breakout type trades. Some of the features of the indicator: Bollinger Bands consist of a center line and two price bands above and below the center line. The center band is an exponential 20-day moving average, and the two price channels are standard deviations of the share price. The channels use a deviation setting of 2 to measure volatility. So this is where we would find the indicator. So under studies, the indicators are all in alphabetical order, scrolling down to B's, and we're looking for Bollinger Bands. Left clicking on that one. That's what it looks like when applied to the chart. And this is the actual settings there. It's standard settings being used for Bollinger Bands. So basically it's calculating on the closing prices. It's using a period setting of 20. So if it's a daily chart, that'd be 20 days, 20 bars. The standard deviation setting is set to 2, and it uses or calculates using a simple moving average. So in terms of color coding, the indicator lines, you can vary them, but you can see the middle band or the median band is colored black, whereas the upper and lower bands are in blue. You can change these obviously to suit yourself and your own style. Standard deviation is a big part of this indicator. It's a statistical term that provides a good indication of volatility. It measures how widely values, which in this case are closing prices, are being dispersed from the average price. So the larger the difference between the closing price and the average price, the higher the standard deviation will be and the higher the volatility. The closer the closing prices are to the average price, the lower the standard deviation will be, and therefore the lower the volatility. So here we see an example of the Bollinger Bands widening quite substantially, which is a sign of increased volatility. So large price fluctuations away from the 20-day moving average will tend to widen the Bollinger Bands, suggesting a period of high volatility. Whereas if the Bollinger Bands narrow, squeeze together, typically happens when share prices are ranging sideways, close to its 20-day moving average, it makes the Bollinger Bands squeeze together, suggesting a period of low volatility. This is usually then followed by a period of high volatility. So here's an example of bands squeezing together. It is a well-known setup with this particular indicator. We would draw in some support resistance levels based around the peaks and troughs that we can see on the chart, and just be waiting for it to actually break one way or the other to represent a possible change in trend and entry signal for a trading opportunity. So we can see that as the share price break out of the period of low volatility, rangy sideways period, you could say, The share prices are trending up and along the upper boundary of the Bollinger Band, suggesting a strong upward trend. So if the price action is running nicely between the medium line and the upper boundary line, it suggests a strong trend. If the price action is running along the upper boundary line itself, it is also an indication of a strong trend. And of course, share prices breaking down through the middle 20-day moving average suggests a reversal in the trend. So that's when we would confirm a change in trend from going up to the start of a downtrend. Once again, as long as the price action sits between the bottom two bands there, the middle and the lower band, we have an overall downtrend in place. So there's an example of the downtrend, obviously being suggested when it broke down through the middle moving average. As long as the price action stays below the middle moving average in the lower boundary band, the trend is down. And of course, if it's running along comfortably along the bottom band, it's a strong downtrend likely to continue. Now, occasionally what we see with these trends in a direction is the share prices will actually break up through the upper Bollinger Band, suggesting an overextended rally, so short-term overbought in that direction. The share prices will typically then retreat back into the rising trend channel and could be used as a profit-taking zone or exit signal for short-term traders. So essentially overextended, overbought in that direction if we get the price action busting to the upside outside of the top boundary band. Now the opposite to that is when it's downtrending and we see the price action breaking down through the lower boundary band. So once again, this is a sign of an overextended, oversold sell-off, usually results in a bit of a counter rally back within the channel before an overall reversal in trend. Can be used as a profit-taking zone if you're into short selling and more of a short-term type trader. So how do we confirm these changes in trend? So if we're looking at an uptrend, price action was sitting comfortably between the middle and the overall rising channel band. As long as the price action stays within those two boundary lines, the overall uptrend is considered to be up and likely to continue. It's when we get a close below the middle boundary line that we have a reversal or change in trend being suggested. So from an uptrend into a downtrend. Sure enough, down it goes. As long as the price action continues to trade between the middle band and the lower boundary band, the downtrend is likely to continue. It's not until the price action begins to break up through the middle boundary band that we have that change in trend and a buy signal that's being suggested once again. Okay, so an exercise you can do with Bollinger Bands. So first up, have a look at some charts, draw in some key levels of support and resistance on your charts. Apply the Bollinger Bands to the charts and use them in determining what the trend is, when it's ending, where you could enter, where you could exit. Hope you've enjoyed our lesson today on Bollinger Bands.